Hello students, welcome to my class. This is Professor Vincent Osaga and this is the presentation of part 6 of chapter 21 presentation, Accounting for Leases. This is where we left off in part 5. We are still talking about special lease accounting problems. Like I indicated, everything that we have talked about thus far is extremely important. From this point on, not too much of a big deal. So here we are talking about the lessor accounting for residual value. Just a couple of things you need to know here. As far as the residual value is concerned, whether it is guaranteed by the lessee or not, the lessor still have to take it into consideration in terms of how much he desires to recoup. So from that standpoint, take a look at what we have here. The fair value of the lease equipment is 100,000. We also compute the present value of the residual value, and we take that into consideration, and the amount to be recovered through the lease payment is 96,000. Why do we back it up? Because by the time the property or equipment reverts back to the lessor will have the benefit of that. So therefore, we back it out of the fair value of the lease equipment in order for the lessor to determine the amount that he needs to recoup from the lease. So that is how we came up with 96,000. Because this lease is over 4 years period, we use the table to determine the annual payment, and that is basically it. So let's take a look at the lease amortization schedule. Again, this amortization schedule is just the same thing as the other previous amortization schedule that we talked about. The most important thing here for the lessor is this table helps us to determine the interest revenue component of the periodic payment that is being received, and we also use the table to figure out the reduction of the receivable or the receivable recovery. So that's not a big deal, and the following journal entries will be made. You can follow this on your own, pretty much same journal entries that we talked about in the past. Okay, this is not a big deal. So now let's take a look at another special issue relative to lease, sales type lease. We said that the difference between sales type lease, as we indicated, and direct financing is the fact that the manufacturer or the dealer or the lessor is actually making a profit out of this lease. So the lessor records the sales price of the asset, the cost of goods sold, and the related inventory reduction. Just like we did in previous accounting classes, we actually make 2 journal entries for one transaction. We recognize the sales. We also make a journal entry to recognize the reduction of the inventory. So there is a difference in accounting for guaranteed and unguaranteed residual values from the lessor standpoint when we are talking about sales type leases. Not too much of a big deal here. So take a look at this diagram. This diagram basically illustrates the difference between direct financing versus sales type leases. All right? Sales type lease terms. For the sales type lease term, we have lease receivable. We also refer to it as net investment, and we compute it by the present value of the minimum lease payment plus the present value of any unguaranteed residual value. The lease receivable therefore includes the present value of the residual value, whether guaranteed or not, just like we indicated. Not too much of a big deal here. The sales price of the lease is the present value of the minimum lease payment, and the cost of the lease is the cost of the assets to the lessor, less the present value of any unguaranteed residual value. Not too much of a big deal. You need to know this, but not you don't have to worry about too much of this, in essence. Now, let's take a look at another illustration. Here's another illustration of sales type lease or leases from the lessor standpoint. It's not a big deal. You can go through this on your own, and you can take a look at some of these calculations in terms of how to calculate the terms that we just talked about a few minutes ago. Not too much of a big deal. Here are comparative journal entries relative to guaranteed residual value and unguaranteed residual value. Just go through these, just for the heck of it. not too much of a big deal. Bargain purchase option from the leasee standpoint, we say that the leasee must increase the present value of the minimum lease payment, must increase the present value of the option. All right. Only the difference between the accounting treatment for a bargain purchase option and a guaranteed residual value of an identical amount is in the computation of the annual depreciation. So what does that mean? Let's take a look at oops, I'm sorry. One second. So bargain purchase option from the leasee standpoint, you can go through this on your own. It's not too much of a big deal. The most important thing that I just want to bring to your attention here is when you have a bargain purchase option, you depreciate the equipment over its useful life. When you have guaranteed residual value, you depreciate the equipment over its lease term. That is basically all you need to know there. That's not too much of a big deal. Initial indirect cost for the lessor, not too much of a big deal. Current versus not current. This is a big deal. GAAP does not indicate how to measure the current and not current amount. Both the annuity due and the ordinary annuity situation report the reduction of principal for the next period as a current liability slash current asset. The most important thing that you need to know here is we also mentioned that a few minutes ago, is the fact that, or in part 4 or part 3 of the presentation, is the fact that at the end of the day, by the time we are done with the recording, journal entry, ledger, blah, 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 when it's time to prepare the financial statement, that is the balance sheet, we need to be mindful that we need to properly classify the lease. Okay? From the leasee standpoint, if you are the leasee and it's a capital lease, you have to properly recognize the current liability of the transaction and the non-current liability of the lease. Alright, so current versus not current. And there are certain things that have to be disclosed as part of your notes to the financial statement when it comes to lease accounting. And these are what we are talking about here. So believe it or not, that is the end of chapter 21.